This is Yang Wang. Welcome to Greenwich Library's investment discussion group series. Today is the last session this this year. The next session will start in September. We always take a break in the summer. Okay, before we start, let me give a brief introduction for the speaker, Kristen Jacks. Kristen is a financial educator, author, and the founder of Money in Your 20s. Kristen worked for Kiplinger's Personal Finance magazine and the Mutual Fund magazine before becoming a writer and a speaker. Her new book on investing is a lively, jargon-free resource for young adults or anyone new to investing. Kristen is a graduate of Duke University. Okay, now let me turn the screen to Kristen. Hey, Kristen. Hi.
Thank you, Young, and thank you to Greenwich Library. They host such wonderful programs. I'm really honored to be part of the programs that you do. And welcome, everybody. Young, if we have a problem with you'll just mute everyone if there's background noise.
Okay, I'll do it.
Oh, perfect. And then we really love it when people participate either by unmuting and contributing or putting things in the chat box. So Young only does that just in case there's background noise. Sometimes people forget that they think they're muted and they're not, but we always love participation. So please, please, please participate. So welcome to our final webinar of season 2 of the Investing Discussion Group. Our theme this year was the best-selling books that will help you reach your financial goals faster. We had some wonderful discussions about the Bond King, the psychology of money, exchange-traded funds, what quants do. It was really a great season. And all of these webinars now live, except for this one, now live on the Greenwich Library channel on YouTube. So if you're not familiar with that, you just go to YouTube and in the search bar, just put Greenwich Library and a few things will pop up. But what you're looking for, I kind of did a little picture of it. What you're looking for is kind of this, this white and green logo with the tree and the book that says Greenwich Library. And then if you click on that, you'll go to the Greenwich Library channel. And they have a lot of great programs that are recorded. I checked on my shows and then ended up listening to the guy who was the Catch Me If You Can. Catch Me If You Can was a movie about a true story, like a true fraudster. It was really fascinating. And Greenwich Library had him live at some point. So, there's wonderful stuff on there. You should really check it out. And all of these webinars live eventually on the YouTube site. Okay, so today, our final book is Misbehaving, The Making of Behavioral Economics by Richard Thaler. And also planning ahead, Young and I are working on next year. So next season, we do one every month. We take the summer off. So that means, so we take July and August off. So there's going to be a new investing discussion group each month except for July and August. So we're planning 10 discussion groups. And we've been working on what would be great topics, and we really, really would love your input. So I actually just kind of put some things here like taxes, the economy, asset allocation, saving for college, bonds, stocks, retirement, just to get your mind working. Like, is it making you remember something you really wish we would cover, or, just give us some ideas. Here's where and please, please, please participate, on everything related to this discussion group. It is supposed to be a discussion group. I know that can be a little tricky online. And if you're feeling shy, you can always just put stuff in the chat. So here's what we have so far. So I'm just giving, these are two where I show you the actual, everything written out. So for example, there's a book about a tax-free retirement, right? So here's the blurb. Ben Franklin said, "Nothing is certain except death and taxes, yet some financial experts promise to help you completely avoid taxes in retirement. Can your tax bill really be zero? Join this lively discussion to learn what the pros know about legal tax avoidance." And this webinar, if we do it, this webinar is based on insights from the book, The Power of Zero, How to Get to the 0% Tax Bracket and Transform Your Retirement. So I thought that was a really provocative book. And, I'm kind of pro taxes. I mean, we all need like national defense and things like that. So we all benefit. But I'm sure people are interested in any strategies that can lower their tax bill legally. So I thought that would be a really interesting topic. Another topic, we're hearing so much now about interest rates and the Fed and things like that. People are just, every week stocks seem to move. It's like the Fed might cut rates, the Fed won't cut rates. Inflation is under control, inflation is not under control. Jobs are, hiring has slowed, hiring is the same. So all of these macro factors are constantly in the news and constantly moving stocks. So I thought another great topic would be, it's the economy, stupid, where investments, because investments exist in a macro environment that can boost or bruise them. So you would join us for the live discussion to learn the key economic indicators that help professional money managers evaluate the economy. And that webinar would be based on the Wall Street Journal's guide to the 50 economic indicators that really matter. So those are some examples of like, when we take a topic and then we flesh it out for you of what we might do next year and do one a month. So here's where we are right now. These are the 10 suggested webinars. But what we really would love is your input. So, in the chat box or unmute, or even you'll get my email later, you'll get Young's email later. You could look at this list right now, and sometimes what can be helpful is like, here's the one I love, and here's the one I don't love. Like, do you have any reactions like, I have no use for this, or I would love to hear about that. Let us know if we're on the right track. Let us know if there's anything we should avoid. But this is what we're thinking so far. So the tax-free retirement, it's the economy, stupid. Bond bombshell would be one webinar devoted to the myth. We've done this before, sort of like the myth that bonds are safe. So people don't really seem to fully grasp how complex bonds can be, and how, especially like when there's a long time to maturity or to actually taking on a lot of interest rate risk. So we would kind of talk about the bonds that can get you in a lot of trouble versus the bonds where you're much safer. And that could also be default risk. It could be the quality of the bond. It could be the bond rating. It could be all sorts of things. So that was our third suggestion. The $400,000 diploma is getting here sooner than you might think. Ron Lieber at the New York Times did a pretty provocative article. It's funny, he used as an example my daughter's college. My daughter goes to Vanderbilt University. And I don't know why he singled out Vanderbilt, because there are plenty of expensive colleges out there, but he singled out Vanderbilt. Somehow he had done the math. And even though Vanderbilt is sort of still in the mid 80,000s, I guess if you're like an engineer and you have to buy a certain computer and you have to do a certain thing, somehow he had figured out that we were like pennies away from 100,000 for Vanderbilt. So this $400,000 diploma, among private colleges is not that far off. So it would be talking about like, is that really happening? How many people actually pay that? Because a lot of people don't, whether it's financial aid or merit aid. But then, because there is this scenario, if you're going to pay something, what are the best savings options? How do 529 plans work? So that's the whole, college saving. What does college cost and what do you need to save route? Start Me Up is about investing in startups. People seem to really like when we did investing in startups this year, whether it's angel investing or they kind of have these crowdfunding sites now that are totally legal. Instead of needing to be an accredited investor, you can go to these crowdfunding sites and participate. So that's kind of cool. They're also on the startup side. There are all these things that are really interesting that if you want to participate in a friend or family startup, you don't have to be an accredited investor. And how exactly does that work? So lots of ideas around startups. Winning on Wall Street is just a classic. So we would just kind of go over the Winning on Wall Street strategy. It was a top-selling book for years. We definitely want to devote some time to the amazing, amazing library resources. Young, do you want to say something about the Wall Street Journal now that anybody can they can just get rid of their regular subscription to the Wall Street Journal?
There's some problem right now. We had it for like 2 weeks, and then they stopped give us the remote access. But now we have remote access to New York Times. So we will, the vendor will figure out how to give us the remote access, but it just stopped for like a couple of weeks already. They're working on it.
I think the Wall Street Journal just cut you guys off because they have so many paid subscribers in Greenwich. They're like, oh my good, and it's
Maybe they
expensive.
realized the problem, so they stopped giving us. But I think that the library is still working on it. We had it for a few weeks, and then they stopped providing.
Yeah. I was wondering about that because I pay a lot for the Wall Street Journal, and the idea that everyone in Greenwich could get it free if they had a library card, I thought the Wall Street Journal is making a really poor business decision. So, okay, well, forget that for now. But there are so many other resources at the library. Like when I want to look up a bond rating, I'm just amazed that you guys have S&P Advantage, and I can get any bond rating I want. I mean, there's just so many great resources. So we would go over that. We should really talk about asset allocation, right? Stocks, bonds, alternative investments, cryptocurrencies, all these things, real estate, all these things that you could do. Predictable pitfalls would be similar to tonight, talking about behavioral economics and sort of the science behind the mistakes that investors make. And then just The Millionaire Next Door is another just like fabulous book, huge winner, and kind of surprising results about kind of who quietly has amassed a lot of money. They're not flashy people. A lot of them went to state school, not fancy private colleges. It's just a great book. And so that's kind of where we are. I wonder if I'm going to look in the chat and see if we had any initial reactions, but please, please, please. Okay, so Young gave her email in the chat. That's great. So her email is Y and then WANG at greenwichlibrary.org. I'm just reading it because I think once it's taped, you can't see the chat. And then you'll see my email later. But if anybody wants to participate, let us know what you'd like, what you don't want to hear about. That would be fantastic. Okay. So let's do the disclaimer for tonight because we are going to be talking about investing. So this webinar is for educational purposes only. It is not intended to provide investment advice. None of the investments mentioned in this discussion group are specifically discouraged or recommended. If you plan to invest, you are urged to consult a wide range of professionals, tax expert, lawyer, financial advisor, who are aware of your unique needs and situation. All right, the book for this evening, Misbehaving by Richard Thaler. Who is Richard Thaler? He's really Dr. Richard Thaler. He has this PhD. He's a tenured professor at University of Chicago. He is a recipient of the Nobel Prize in Economics. He's considered the father of behavioral economics, a relatively new sphere of economics. He's the author of Misbehaving and Nudge. And I just threw this in so that you know how relevant his work is. It's not just academics and theory. He has been credited as being personally responsible for billions of dollars flowing in to retirement funds all over the world because he consults with various governments where people who otherwise weren't participating in retirement accounts, he used what he had learned, his research in behavioral economics to figure out how to kind of nudge people toward participating, and really not pushy, not sneaky ways. These nudges are very just, they seem so sort of obvious, right? Like if you have a retirement account and you're joining a new company and they have a 401k, instead of having to fill out paperwork to get into the 401k that you're entitled to, you actually have to fill out paperwork to not participate, right? So there's the nudge. It used to be you had to sign up for your 401k. Not enough people were doing it. So now it's like, well, if you don't want to participate in your 401k, you have to do paperwork. Otherwise, you're automatically enrolled. And so that's just a great nudge, right? It seems so obvious, but a lot of companies and governments were wringing their hands, like, how can we get people to do this? It's so important and it's so good for them, but nobody wants to be bothered. And it's like, well, make the default that you're doing it. and you have to go out of your way to not do it. So that has really, really helped retirement in general. A second huge thing that he did was called Save for Tomorrow. This is not Richard Thaler alone. He has always worked in collaboration with other experts. I'm blanking. I think it's Shlomo Benarzi. I mean, some of these names are a little tricky, but the Save for Tomorrow plan is not only are people now enrolling in their retirement plans, but people need to be saving a lot. And when they first enroll, they're afraid to save a lot. They're living probably paycheck to paycheck. They don't feel like they can come up with 10% or 15% to devote to their retirement savings. So he devised a plan where you agree as the employee that every time you get a raise, a certain fraction of your raise goes into boosting your savings. So then, over a 5-year, 6-year period, someone who had started out just saving 3% of their paycheck is close to saving 15%, and it's effortless. They never got used to having the money. So these were all these very clever things that he did using what he had learned about people in behavioral economics. So, okay, so how can the book Misbehaving, which is kind of the story of his personal, growth and his career trajectory, and also the work that he did with his colleagues to get behavioral economics accepted, because it was definitely not accepted originally. So how can this help you, right? So like this seems a little bit dry material, right? An economist, PhD economist trying to get other PhD economists to take him seriously. Why would that matter? Well, economics matters, right? It matters a lot in different ways. Most specifically for our purposes as investors, it matters in terms of asset pricing and investor behavior. But economics matters across the board. I mean, like, what the Fed is going to do, what the Fed is advised to do, what economic advisors tell the president, they're all coming from the same top schools. They have the same, backgrounds in economics. And there were all these assumptions about what's correct for the economy, how people behave, that behavioral economics started to challenge. So if you're going to have like public policy based on economic theory, and economic theory is flawed, that's pretty serious. If you're going to have investing behavior, assumptions about investing, and if you're going to give advice about investing based on economic theories that are too rigid, too rational, that's going to be a problem. So it definitely matters. It matters for us, and you'll hopefully believe more of that tonight. Very specifically, I mean, not to get too in the weeds, but prospect theory and the endowment effect were sort of the first things that were kind of more scientifically proven, that really challenged cherished beliefs, and really kind of rattled traditional economists that kind of like announced that behavioral economics was here and again coming for some cherished beliefs. There's definitely, because of behavioral economics, there's a lot more wiggle room on the efficient market hypothesis that has just dominated investing for so long. So we'll get into that. And also the research in behavioral economics has uncovered that investors make predictable errors. So it's going to be really important to uncover those predictable errors. Now, beyond the book, I would just like to offer, so this book is a great starting point, but of course, Richard Thaler's talking very much about his personal experience, his mentors, his research. He gets into the research of a few of his colleagues, but he started something that has just taken off, right? So he likes to say that he hasn't changed the minds of any of his colleagues who are also, 70-year-old economists, but so many young people coming into the field gravitated to behavioral economics. They were so glad that it was getting beyond like the dry, rigid math and things like that, that so many new theories have popped up. So much research has come along that there are like a plethora of predictable errors that I think we should cover, so that so you don't make the mistakes that the scientists are saying these are predictable errors. Like, so let's point them out to you, and you can just monitor yourself and make sure you're not making them. I just feel like more and more could be said beyond the book about the efficient market hypothesis that has so dominated investing. So if the efficient market hypothesis, if the grip of that theory is loosened and we think of, I kind of came up with this. I was like, well, what would I say? It's not that it's not true. It's that, like, if you think of it more as like a gravitational pull, like markets, are pulling back toward being efficient, for prices to reach some kind of equilibrium, for the price to actually be right and not kind of off in some too high or too low overreaction. So if you think of that just as a gravitational pull, not an instantaneous thing that happens, then there are some opportunities there. A little bit more like day trading, but there are opportunities. There are also some things to avoid, right? So if you're buying assets thinking the price is always right, that's what the efficient market hypothesis says, be a little cautious, because there's plenty of evidence that that's no longer true. And then also, always good to talk about asset allocation, and what is the research telling us about asset allocation. And then there's always time for Q&A. You don't have to wait for the Q&A. You can put anything into the chat or unmute, but we will have that at the end too. Okay, so hopefully you're here because you do believe that behavioral economics is important, and you're here because you believe economics in general underpins investing and public policy and all sorts of things, right? So what happened? Like, why was behavioral economics at first so ill received? Because it was. So why did Richard Thaler call his book Misbehaving, right? Like as though he was doing something wrong. So it's really, really, really interesting. And I think John Maynard Keynes is a very familiar figure for anybody who takes investing seriously. He introduced ideas that kind of shook up economics back in, I guess his most famous book was 1936. So he was kind of rattling people with his ideas, but his ideas ended up being very accepted. And he anchored his ideas in the idea that people are emotional, right? They're not purely rational. They make emotional decisions with their money. And he kind of alluded to these emotional decisions as animal spirits, right? So you could say that he's like a precursor to behavioral economics, because he was talking about sort of less than rational, less than purely logical behavior in the 30s, and people were accepting it. He was also talking about the stock market in ways that were to become completely unacceptable. So I will get to that. But he was willing to say that in terms of picking stocks, the whole market was like a beauty contest, in the sense that it was the job of the investor not to just pick the best stocks, like you would pick the most attractive women, but that you needed to pick the stocks that other people will find attractive, right? So you're not just going by what you think is a good buy. You have to, using like the law of supply and demand, you're hoping that other people will have a demand for these companies, these stocks in the market. So he kind of did this beauty contest of, it's not just picking the best looking women, it's picking the women you think other people will find as the best looking. So that's the way he was talking about the stock market in those terms, was very relatable, but would soon become completely unacceptable, because Paul Samuelson and his colleagues come along and they don't like all of this. It's unscientific, right? It's just, it's, it's anecdotal, it's storytelling, it's, how do you measure these things? So Paul Samuelson comes along and he's considered just absolutely brilliant. And he just starts pushing economics to something much more concrete, much more rational, much more mathematical, right? So it's almost like he was a little bit embarrassed by economics and how I don't know, just theoretical it was, unscientific. And he started having he just changed the world of economics, and it became unacceptable to talk about theories unless you could back them up with evidence and math. And math was like a big part of it. And then Eugene Fama comes along. I'm skipping a whole bunch. I'm just doing broad brushstrokes. There were a lot of theorists, a lot of great people, at work in economics, but the whole the whole science was becoming much more rigid, much more mathematical, much more scientific. And also, by the time Eugene Fama comes along, now you're starting to have computers and computing power, right? And Eugene Fama at University of Chicago has access to all of this market data that and access to supercomputers. So all of a sudden you have so much more data to rely on and the computers to run the data. And so just sort of this overhaul of economics from almost storytelling and theories to hard science and hard data. It was like a transformation, right? So then like people like John Maynard Keynes and his ideas, they went from being central to not even being taught at business schools. It was just a complete transformation. So that's really where we are, where we were with economics when Richard Thaler comes along, and he's studying to get his PhD in economics, and he's learning all of these theories, and he gets his hands on Keynes somehow, uh, but he's really disenchanted because the theories that are coming up now are just about people being optimizers, people being highly rational, that all economic decisions are, can kind of be mapped with math. And the whole point of these theories, the whole point of theories in general is to notice something and be able to prove your theory so that it has predictive power, right? So if you're going to have this prediction of how people will behave, whether when they have incentives or they lack incentives, right? So all of these all of these theories now that he is learning, Richard Thaler is learning in his PhD classes, he's starting to question because they're hyper rational and they're hyper mathematical. And he's like, well, people don't really act that way, right? Like he kind of referred to people stop being referred to as people. Also, they start being referred to as agents, right? And how these people will act in a marketplace is based on hyper rational decision making and optimizing, and there is no emotion, there are no self-control problems, there's no bias. And so Thaler is learning all this stuff, and this is his chosen profession, but it leaves him kind of cold. And he also just doesn't think it's accurate. He doesn't think that economics is going in the right direction. He thinks that John Maynard Keynes had the right idea in the 1930s, and now everything's become, almost too like robotic. So that's when you get to Richard Thaler's work and his mentors. So he wants to go down this path, but where's he getting his inspiration? So let's look at some of these eventual Nobel Prize winners. So in his book, Richard Thaler talks about his mentors, his collaborators, his inspiration. And the guy in the middle, Daniel Kahneman, who until he passed away was Richard Thaler's best friend. They start collaborating in the 70s, and Daniel Kahneman had been partners with Amos Tversky. They are Israeli psychologists. They're not even economists, but their work on how people make decisions, and so they're psychologists, they're PhD psychologists, and they're in Israel. They're actually working. They're part of the Israeli army. This is post World War II, and they're doing all of these discoveries on behalf of originally the Israeli army, and then they just become actually when they were right post World War II, they weren't working together yet. They just happened to both be in the army, but then they become sort of collaborators and best friends. I think they were at Tel Aviv University, but don't hold me to that. And they just start noticing all this quirky stuff about decision making and about how people behave. And they don't know, they're not part of the economics universe. They're not hanging out with economics professors that are hyper-rational. They're just going from the psychological perspective of how decisions are made. Their work becomes really, really well known and really popular in academic circles. And somehow Daniel Kahneman and Richard Thaler and Amos Tversky all get to know each other. And Richard Thaler is amazed by their work. So I'll give you one example. So, you would think, in a rational world that if someone has a reasonable amount of financial security, right? So not somebody poor, but a reasonable amount of financial security. If they earn $100 or they lose $100, those would be sort of equal, they'd have the equal force, right? I mean, obviously, you'd much rather earn $100 than lose $100. But, how does it feel to earn 100? I'm not explaining this correctly, but what Kahneman and Tversky came up with is something called prospect theory, later called loss aversion, where they were able to see that losses have twice the impact as a gain. So whatever, mood lift or feeling or whatever, however you would register making $100, the impact of losing $100 has twice the force, right? It's twice as bad to lose $100 than it is good to earn $100. And from an economics perspective, this makes no sense, especially somebody who's very financially secure. There should not be any measurable, identifiable effect that has like twice the loss should not have twice the power of the gain. So Kahneman and Tversky, discover this, and they can prove it, and they write a paper about it. And this is just one of many things that they're able to isolate and prove with their research that is unexpected from the point of view of an economist. And Richard Thaler is slogging away in his dry PhD classes, and he's miserable, and he's like, all this economic theory isn't correct. It just kind of lacks emotion, and that's not how people behave. People are not brilliant, clinical, cold optimizers. They're human, right? So Thaler becomes completely enamored of Daniel Kahneman and Amos Tversky, and somehow he finagles a way to work with them for a year directly, to just be on the same campus with them at Stanford. And Misbehaving kind of gets into how Daniel Kahneman and Amos Tversky, even though they are psychologists, they are really, equally, they should share equally in starting behavioral economics, because their theories were such an inspiration to Richard Thaler, and they really got the ball rolling. And to this day, a lot of the biases that they've identified are the ones also that I want to cover later just for investing. But, their work has just been so seminal, and they've been so prolific. And sadly, Amos Tversky was not able to share in the Nobel Prize because you're not allowed to receive it posthumously. Sadly, he died at age 59. He died in, I think, 1996. But this story starts in the 70s, and he was he in the 20 years that he was still alive, from the mid 70s to the mid 90s, he did amazing work. Okay, so enough of that. That's where we are with the Nobel Prize winners. And again, I want to say, like, the history of cognitive biases, the term is actually coined by Amos Tversky and Daniel Kahneman, right? So these guys are super. I mean, if you've heard of cognitive bias, it's because of them. Okay, so how can misbehaving help you reach your financial goals faster? So, economics matters, right? So it matters in many, many ways, but especially for investors, up to the point before behavioral economics comes along, there were economic theories about how assets get priced, right? And how investors behave, right? So if those theories are wrong, that's something that we need to know. And that's kind of what behavioral economics does. Okay, so let's just talk about, the popular thinking, the sort of accepted thinking about how assets get priced, right? So you have your bottoms up way of pricing assets. And so you're going to be looking at the balance sheet and the income statement and statement of cash flows and who's in the leadership and who's in the management. And so these are, and when we refer to the fundamentals, the fundamentals of a company, this is what we're talking about. So that's the bottoms up approach. You also have the top down approach, which is looking at macro factors, macroeconomic factors, right? And we had talked about maybe next year doing Winning on Wall Street as one of the investing discussion groups, because that's just been, it's just been a huge success. But that's a whole top down look at macroeconomics and how that impacts Wall Street, right? So, that's the interest rates, Federal Reserve policy, things like that, what's going on in the macroeconomic world. Now, technical analysis, I have to throw that in there because there are people, even if they're a minority, there are people that really believe, and they're called chartists or technicians, that there are patterns in the price movement of a stock. And also when you look at both price movement and the volume of trades, that has some kind of predictive power. A lot of people think that's bunk. But if you're going to go with like the top ways people think assets are priced, there's fundamentals, there's macro, there's technical analysis. And then before behavioral economics, you actually did have this idea of sort of like the market is manic depressive, right? So even going back to Benjamin Graham and the Intelligent Investor and, all the way back to the 30s, this idea that like the market is sometimes too high when it's high, it's too low when it's low, that there's this sort of human behavioral, emotional aspect to it that's a little bit irrational. So that was kind of a precursor to behavioral economics, but it was there. So, oh, okay. I don't know why I did that. Okay. So we have all of these ideas about where do these prices come from? Where do these asset prices come from? But before Richard Thaler comes on the scene, what you really had was, forget the manic depressive market. So that fell out of favor. Absolutely no technical analysis. That was like verboten, like no way. So you're really left with fundamentals of like what's actually going on inside the company. And you're left with macro. So, what are the interest rates? What's the Fed policy? How are jobs doing? All those things. And so the asset pricing was really supposed to be very soberly based on those two factors, right? And just hyper rational. And because all of this was supposed to be rational, and actors in the market, the people doing the trading, the buying and the selling, were considered to be very rational, the investors. That's where we get the efficient market hypothesis, right? So Eugene Fama at University of Chicago looks at all of the data, and he's like, basically, he was talking about stocks, right? But it's been extrapolated to other assets. But that the market is efficient, that you have these actors inside the market that are carefully looking at fundamentals, carefully looking at macro, and they're reacting to news, right? So like it would make sense that if interest rates go up, or if there's evidence of inflation, like that could have a negative impact, right? But the idea is that the impact would be like immediately reflected in price, and it would be sort of soberly reflected, right? That people, no one's going to overreact or underreact. And this was economic theory, and this is efficient market hypothesis. The price is right, the market reaches an equilibrium, and that's all you need to know. So Thaler sort of, just sends this out. There's one slide I wanted to get to. Okay, here it is. So also like today's index investing, kind of originated with this academic research where you had Paul Samuelson and Burton Malkiel and Eugene Fama and the efficient market hypothesis. So this is all hyper rational, and there is no emotion, there is no behavioral economics. So the market is efficient and you cannot beat it, right? Because whatever the asset is priced at, it's kind of like immediately reflecting all of the known valid information, whether it's macro or fundamentals, and especially once you've paid your fees and the taxes and things like that. So your fee to your financial advisor, your fee to your asset manager, there's just nothing to be gained by trying to beat the market, right? And all of this kind of like hyper rational led to that there should be no market timing. You should stay fully invested. Don't hold cash. You can't beat the market. I mean, so much of what you are told as an investor really comes from this very rational approach and comes from the efficient market hypothesis, right? Well, Thaler turns this on its head. So he goes to using prospect theory and the endowment effect. When those two things happen, so prospect theory is the loss aversion we were talking about. So Daniel Kahneman and Amos Tversky kind of prove that people are not rational in terms of when they're up or down, right? So if they've gained something, they feel fine. But if they've lost something, the impact of a loss has sort of twice the weight as the impact of a gain. So that just doesn't, for economists, that hadn't made any sense before. So there should be no dramatic loss aversion, especially for something as small as $100. That, like, why would that have such an impact? So, and then you can imagine that just gets magnified, right? So Thaler is seeing this and he's saying, like, now I've got something to hold on to. I've got something to show that people are not rational, that they are really crushed by losses much more than they are lifted by gains. So that's the prospect theory, that's loss aversion. Then there's the endowment effect, which was Thaler's own research, where he showed that if somebody personally owns something, that they give it more value. They kind of lose the logic, right? So it could be something as simple as a mug, right? Like just a coffee mug. If it's your own personal coffee mug that normally retails for like $11, you will actually not, once it's yours and you've owned it for a while, you will not turn around and just sell it for its, market rate. And that doesn't make any sense, right? I mean, like, you shouldn't get so attached to things. The fact that you've owned it shouldn't really make any difference, right? But he showed in research this endowment effect. And between the prospect theory and the endowment effect, those two things together, the fact that they could be proven, maybe this does not seem that very earth-shattering to you, but if you were walking around all day in like an economics department where everything was hyper rational and predictive and things like that, and you're starting to see just sort of cracks in that rationality, cracks in that, predictability that people only optimize, right? That they think dispassionately, they don't get attached to things, they don't have loss aversion, and they have no self-control problems. They're just, basically robotic in their decision making, and they just optimize, and that's it. So this opens like a whole can of worms, right? So this, because of prospect theory and because of the endowment effect, Thaler starts to make a name for himself. He starts to be able to get research funded. He starts to convince other people to take all of this seriously. And Kahneman and Tversky were a big part of this. And so and the book covers this, like, kind of out of the woodwork, you have really smart graduate students gravitating to this kind of work. And you have, I guess you would call them like think tanks. I don't, like the Russell Sage Foundation, or these kind of nonprofit foundations that can just fund new ideas, kind of come out of the woodwork. And all of a sudden there's like a summer camp, a paid summer camp for graduate students who want to do this kind of work. And there's just this shift away from the hyper rational, hyper mathematical world of economics to, well, what are these biases? Like, what are these anomalies, right? Actually, I guess calling them anomalies, he uses that in the book a lot, that there are going to be behavioral anomalies that people cannot explain. But before I lose you, let me give you a quick anomaly that's very connected to, where is it? Okay, so it's very connected to investing. So if you've never heard, like this is a behavioral anomaly. Like a normal economist would say this should never happen, right? In terms of asset pricing. So there's something called momentum, right? So, and I just took this quote from Eduardo Repetto that momentum is fascinating. Momentum is something that we observe, but we don't understand why it happens. A security, like usually a stock, that has extremely bad performance will continue to have, for some short period of time, bad performance. And a security that has extremely good performance will continue to have, for some short period of time, good performance, right? So momentum is one of these anomalies that behavioral economists discovered that just makes absolutely no sense. You know, if markets are efficient, if prices reflect, fundamentals and macro, that shouldn't creep. It shouldn't creep higher, and it shouldn't creep lower. There should just be like the price is the price, and it reflects the current information, and there should be no pattern of it creeping higher or creeping lower. But that's exactly what momentum is, and so nobody can explain it, but it's been observed, and it's been so consistently observed and so consistent, period, that investors use it, right? So professional money managers use this all the time. So for example, the way like you could use it is if you happen to own a stock and you've noticed that it's gone down kind of consistently, or actually, let's see, a better way to use it would be if you own a stock and you've noticed it's just been like chugging up, up, up. And you're like, oh, I'd like to capture some gain there, like that. I wasn't expecting that to happen. I'd like to capture some gain. Well, if it's been chugging up, 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 maybe don't sell it right away, because momentum theory would say that it's just going to continue to do that, right? That it just, as things, when things are they are going up, 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 they just kind of continue to do that, whether it's logical or not. When things are going down, they kind of continue to go down, 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 which can be a problem. So if you're starting to notice that pattern on something, a security that you didn't love anyway, you're better off getting out early than hanging out for the ride if you were planning to sell it, right? If you weren't planning to sell it, just try not to look, because it just, beyond reason, a stock that's going down will continue to go down. It will rebound eventually. It'll get back to its fair price. And no one really knows why this happens with momentum, but that's, just one of those observable anomalies. Okay, so getting back to, sorry. Okay, so the fact that there is wiggle room on the efficient market hypothesis is really, really important, because of the efficient market hypothesis, you have been told as investors over and over, you cannot time the market. You should only buy index funds. You cannot beat the market, right? As though there are no opportunities, as though prices always immediately reflect, the known information. And so there just are no opportunities out there. And in Misbehaving, Thaler shows his own research. He also shows the research of Bob Shiller. So Bob Shiller is one of these Nobel laureates. So where's Bob's happy face? There he is, Robert Shiller. You might know him. He's famous for coining the term irrational exuberance. So he called both the tech bubble and the housing bubble. According to regular economic theory, there should be no bubbles, right? Like the price is always right. So Robert Shiller is basically like, he is the antithesis of Eugene Fama at University of Chicago, who came up with the efficient market hypothesis, because he's saying, of course prices get out of whack. Of course bubbles exist. Of course people overreact and they chase returns and they pile on, and they literally create bubbles in the way that they chase returns, right? So Robert Shiller is another one of these people who's going to kind of challenge the efficient market hypothesis. And what's important with that, when you challenge Here, let's get back to, where is it? Okay. So if there's wiggle room in the efficient market hypothesis, that means that you have some leeway in having some opinions, right? Just having opinions about assets and stocks and things like that that might be worthwhile. Let me see. There's a question in the chat. It is ironic that Schiller and Fama won the Nobel the same year. Totally. That is so true. And actually, I don't know if any of you guys watch or listen to the Planet Money podcast. And they did a great podcast about Schiller and Fama winning the Nobel Prize together. That was not expected to happen because they're really opposites and a little bit enemies. But I definitely recommend that Planet Money. I'm sure it wouldn't be hard to find if you go into your podcasts and if you put in like Eugene Fama and actually put in Eugene Fama and Robert Schiller, and it would probably pop up because there can't be too many podcasts about the two of them. All right. Okay, so if there's wiggle room on the efficient market hypothesis, that basically what behavioral economics is allowing you to do is believe that there are times when the market is out of whack, when an individual stock or a bond or a home price or whatever, that something is out of whack, that there is opportunity there that isn't immediately, equilibrium is not immediately reestablished by other people kind of noticing, or they talk about like arbitraging away or whatever that language is, that you actually could possibly find an opportunity. And that's a really important thing. I would say that those opportunities tend to exist more in day trading, which that has a lot of problems of its own, because most people have jobs where their hourly rate or what they can earn out in the marketplace, it's a much better use of their time to work on their careers than to sit in front of a computer screen and try to find some kind of mispricing. So I'm definitely not advocating day trading, but really the only reason day trading exists is because there are definitely in the short term mispricings that people kind of jump on. But also just in general, like, if the market to you starts to seem like even overheated, right? Like the Magnificent Seven, these stocks that have really high PEs that have been going up for years. That should give you pause, right? Like the efficient market hypothesis says it shouldn't give you pause. Everything's adequately priced, right? All the information is in the price. Nothing's overpriced. But that, that just doesn't seem true, right? So you're allowed to have some opinions about, I think this market might be overheated, or like, maybe there's going to be reversion to the mean, right? There's going to be some kind of a reversal. If the efficient market hypothesis were absolutely true all the time, you wouldn't really be entitled to those thoughts. Okay, so then I want to get onto the predictable errors, because that is a huge area. And I just want to check the time. Okay, so what these guys do is they kind of open the floodgates to the irrational side of things, right? And in that irrationality, it's not enough to just say that people are less than rational. It's really important to identify patterns, right? Because the whole point in academia is that you have a theory so that you can predict. It's all about predictability. So Tversky and Kahneman, as psychologists, they're identifying things that end up being predictable errors, right? And you've heard a bunch of these. So confirmation bias, right? I'm sure like most of you have heard of confirmation bias. They were able to prove that people are, people do not have like an original clean relationship to information, right? So say you're investigating a stock and you're doing research. If you personally, privately want to buy that stock, if you're kind of like excited about that stock, you're coming to that research with a bias, a confirmation bias. You're going to look, you're not going to do this consciously, but you're going to look for information that confirms the good things you already believe about the stock. And your brain is going to ignore this sort of the evidence that would say maybe it's not as good as you think, right? So that's what the confirmation bias is all about. Whether it's in politics, whether it's in investing, you're not having a true original relationship to new information. You are somehow, your brain is somehow tricking you into kind of zeroing in on the things that confirm what you already believe and helping you to ignore the things that challenge what you believe, right? So that's like a huge error. That's a really troubling error, especially if you're going to put money, say you're going to spend $2,000 on one stock, right? If you're not soberly looking at all the pros and cons, you can get in real trouble, right? So that's one of my favorite, like, predictable errors that, so Thaler talks about that in his book. But I would like to get a little bit beyond the book into it, just kind of a deep dive into these predictable errors. And this is being taped, so you don't have to worry. You're not going to miss anything. You can always go back and look at all the things that were talked about. But one bias that's really, really important that's been proven is the action bias. So we are biased as people. We're just biased toward action, right? And which makes sense. I mean, if from an evolutionary perspective, right? If if some predator is coming after you, it's like fight or flight, right? Those are actions, right? It's not freeze, it's fight or flight. You're going to do something about the current event of some predator, appearing. Well, we have a bias toward action in our investing, which is not necessarily good. In fact, the research shows the people who tinker less with their investments, the people who trade less, tend to do better. Now, that doesn't have to be true, actually. It's biases getting mixed up, right? So there's an action bias, but then there's also sort of this fear and greed that goes on where we tend to panic and sell things that aren't doing well and pile on to things that are doing well. So, we have this action bias, but if we were actually able to buy low and sell high, the action bias wouldn't be that bad. But we have a bias toward action when we should actually be sitting on our hands. And unfortunately, we also have this bias of panicking when an asset goes down and not being able to ride out when it goes down. And we have a terrible habit, I say we, like, the average person has a terrible habit of chasing returns, right? So Bitcoin, really, the only reason people piled into Bitcoin is because other people were piling into Bitcoin. It's really hard to make a rational case for the value of Bitcoin, but or even the meme stocks that have lately had a resurgence, and even I own some AMC just because it's so easy. If you are able to use the behavioral errors of others to your advantage, then you too can own a meme stock, because I get into these things. I watch other people go literally bananas, and I get in for a very short amount of time before things kind of explode, because people are being crazy. They're bidding up the price of something that is, worth way beyond what its value is, but they're sort of enjoying the meme stock ride. Okay, so here I've got my list, is why I keep looking down. So the action bias, and keep track of this, right? Like, do you have a confirmation bias? Are you completely open to new information? Do you allow your thoughts to be challenged? Probably we all have, we're just, by nature, we want to confirm what we already believe. So you have to work against that bias. Sit on your hands, right? The action bias will work against you unless you really truly are one of those people who can buy low and sell high, rather than the opposite, which is unfortunately what most people are doing. There is an overconfidence. This has been proven on so many levels, right? I was listening to a podcast where there was research that 93% of drivers think they're better than the average. I'm in the 7% that doesn't think that way. I grew up in New York City. I didn't start driving a car till after college. I'm like, I am definitely a below average driver, but apparently that's super unusual to make a sober assessment of my like mediocre driving skills. But overconfidence could kill you in investing, right? You definitely don't want to be overconfident. I mean, the greater fool theory kind of, you probably in some cases will be the greater fool. You'll be the person that gets sold an overvalued asset because the person who bought it was just looking for the greater fool to hand it off to. So you got to be extremely wary of confidence in markets, right? There are a lot of smart people out there. There are a lot of people that are trying to like sell you. It's if you're buying something and like you really have to ask yourself who's on the other side of this. If it's so good, why would they sell it to me? Why wouldn't they just keep it for themselves? So that's a big one. The recency bias is really, really interesting. So we just have a bias to feel that whatever is more recent is kind of more real, right? Which can really hurt because, right now the stock market's been doing pretty well, right? Things have been pretty smooth sailing. The market's kind of at an all-time high. So if we have a recency bias, then we're going to think that like things are pretty good. Stocks usually go up, go back to 2020, go back to 2000, 2008. Like, obviously, markets crash. Obviously, bad things happen. But, that's pretty far in the past right now. So it's not a great idea. If people tell you over and over again, never put money in the market that you're going to need in 3 to 5 years, never do it. Well, I'll bet there's some research that shows that people do it anyway while the market, in the last year has been pretty calm or pretty nice or going up. I mean, that would be the recency bias, right? So it's much easier to follow that advice when the market has, recently been pummeled, because then it's like fresh in our minds that things can just kind of crash, go down 20%. That's much more familiar. Okay, home country bias, right? That's a big one, especially for asset allocation. All right, actually, there's a slide here. I definitely want to show you this slide. Let's get rid of that home country bias. Here it is. Okay, the top 5 performing stock markets. So I only have the data up to 2021, but isn't it interesting, right? US isn't the top performing market in 2021. The US isn't the top performing market in any of these, right? I mean, it's Austria, it's Denmark, it's New Zealand, it's Finland, it's Canada, it's Israel, it's Belgium, it's Ireland. I mean, we never, from 2021 to 2010, not one of those years was the stock market in the US the best performing market. That's so interesting. But how many of us have any Irish stocks, have any stocks from Austria, have any stocks from Denmark or Canada? Actually, Canada probably. I mean, I think a lot of people do Canada. But we have this home country bias. It's just a known bias. Not only do we have it as Americans, everybody has it. The Canadians buy Canadian stocks. The Australians buy Australian stocks. This is completely proven. But it could be really bad, right? It's like missed opportunity. And also, you're concentrating your bet. Like if everything is inside your own country, when you have the opportunity to diversify, why not diversify? This is definitely something that you want to get some expert help on, because the tax consequences of participating in certain countries can be very confusing. I'm certainly not an expert on it, but you will have to most likely hand over some of your gains to that country as a tax. Or maybe just go into a fund, right? And let the fund figure it out. But don't ignore other countries. I mean, here, there's these fabulous companies, right? Like Shell and Siemens and GlaxoSmithKline. I mean, there are wonderful companies all over the world that we just tend to ignore, right? But again, be careful. I mean, you want to be diversified and you want to be diversified outside of this country, but be careful because you want to make sure that you understand the tax consequences, because that can be a little tricky. Okay, so before I forget though, one of the reasons it really bugs me, the efficient market hypothesis, The efficient market hypothesis led to people really thinking you can never beat the market, and then really thinking that your only solution was index funds. And index funds are great, okay, fine. But there is this flaw with index funds that I really try to bring up, that people do not understand the typical index fund. So if you believe that the efficient market hypothesis has maybe been somewhat disproven, then maybe you could be a little skeptical of the typical index fund, because when you go into an index fund like the S&P 500 index fund, which is probably America's most favorite investment, if you think this is what you're getting, if you think you're getting all of these top brands like Starbucks and FedEx and IBM and Walmart and Zoom and Kellogg and Coca-Cola and all that. I mean, I look at this slide and I'm like, oh, I'm so proud to be an American, and I love these companies, and what a no-brainer. Who needs to go anywhere else? Let's just get into that. Let's pile into that index fund. Let's get some of that Disney and Visa and Lilly and Meta. Like, let's do that. Unfortunately, most of the time, almost all of the time, whatever index fund you're in is going to be cap weighted. So that's weighted by market capitalization. So that means that the larger a company is, the bigger position it has in the index fund. And because of the way information technology, because of the way that Apple and Amazon and Nvidia have taken off, they have completely messed up, in my opinion, what people think they're getting in an index fund. So this is what you're really getting, okay? Because of cap weighting, this probably sounds confusing, but when you buy an index fund, the larger the company, the greater share of the index it's supposed to take up. And we've just, over the years, Apple has become enormous. Alphabet, which is Google, has become enormous. Nvidia and Microsoft are enormous. Berkshire Hathaway had a big bet on Apple, which was probably one of the reasons so it grew along with Apple growing. But you are no longer, you're getting tiny, tiny, tiny amounts of Starbucks and FedEx and the Hartford and Target and Kellogg and all these great brands that keep you very diversified are just a tiny, tiny fraction of your index fund. Meanwhile, the last time I checked, the Magnificent Seven, so Microsoft, Apple, Nvidia, Alphabet, which is Google, Amazon, Tesla, Meta, they were 27%. Those seven stocks were 20% of an index where you thought you were getting a somewhat even distribution of 500 companies. So just be really, really careful. Like, if you learned anything from behavioral economics, you learned that maybe you don't have to only do index funds, especially because I think index funds these days are so flawed and they're so overweighted. And if we ever have a reversion to the mean, any kind of reversal in these information technology companies, people are going to get hurt, right? They have so far to fall. They've grown so much if there's a reversion to the mean. So, okay, before I forget, let me just make sure. Okay, so we've got the wiggle room on the efficient market hypothesis. We've got the predictable errors. The deep dive into the predictable errors, right? So that was the action bias, the confirmation bias, the overconfidence. I just want to make sure I'm not forgetting one, the home country bias, right? So we're going to look beyond that. Then there are just certain things that are just kind of funny, like anchoring. So apparently, as you're going to make a decision, if you're, like, say you're trying to figure out how much of a certain asset to buy, you can be anchored, like your decision can actually be swayed by something that happened very recently around you, right? Like if you just saw you just saw a number like 3,000, instead of buying $500 worth of a stock, you'll be more likely to buy closer to 3,000. This is like a known effect. But if you just saw a number like 20, you're more likely to buy a smaller amount of the stock. Like that, we get anchored to things in our environment that are completely related to what we're doing, and it's totally illogical. So some of this is just kind of just hilarious, really. But I think we covered The recency, the most important ones are the overconfidence, the confirmation bias, the recency bias, action bias, home country bias. I think those are really the big ones. And then what started it all with prospect theory, which is really loss aversion. I mean, it's a very curious thing to think about. Are you really being rational in your decision making if you're so much more concerned with losses than with gains, right? So that could be sort of a risk aversion, loss aversion, risk aversion that you might want to tackle in some way. I mean, you could do it with like a stop loss order, right? To just be like, I know I'm afraid, I'm inordinately afraid of losses, but maybe I can kind of manage that. I can take on more risk because I'll put in a stop loss order where if I start to lose like 7 or 10%, I can just get out of it before it gets worse. I mean, these are some ways that you can kind of manage that stress. Okay, let's see. Was there anything? Oh, so this is kind of interesting. So the book Moneyball, that was like such a huge hit, right? Now Moneyball, you would think so. Moneyball, because it was, if you don't know the story, so it's like the Oakland A's were this baseball team that didn't have a lot of money, and they wanted to use science and data in the selection of their players because instead of just kind of like going out and throwing money at problems and buying big star players and things like that, they were like, how can we use like probability and statistics and data and all these things to like assemble a team with our kind of meager funds that could be like the winningest team. So it's actually a great book. But the reason I bring it up is that a lot of people think that Amos Tversky and Daniel Kahneman, the psychologists, that what they were discovering, they were just sort of discovering all these biases that kind of expose, how silly people are, how bad their decision making is, and that there would be like no use for it. But actually, the book Moneyball uses those biases and uses those errors in decision making to actually create this amazing baseball team, because it's like if you isolate those biases and you say like, okay, well, we're not going to do that. We're not going to go by gut instinct, right? We're not going to, I guess there are some biases where almost like a stereotype, right? Like if somebody looks the part, like whatever, I don't know how you look the part of a baseball player, but they basically figured out that someone who is a little bit overweight doesn't look like a baseball player, or someone who's too short, or someone who's too tall, or someone who's too skinny. Like that, we have all of these biases about how someone should look. Well, that should not matter, right? Because the statistics are statistics. I mean, people in baseball, like the numbers don't lie. It's like you stole this many bases, you had this many pitches, you had this many outs at bat. Like just look at the statistics. Do not look at the human form, right? You care about what the human form is able to do on the field, not how it looks. So apparently, the whole book Moneyball was based on using the science that Kahneman and Tversky discovered, and it really like transformed that team. And they went on to be, they had some winning streak. I don't know if it was 20 wins in a row or something like that, had never happened before. It was like a huge deal, and it was really based on kind of using all of the science. So the point of behavioral economics is not that you discover all these biases, you discover people are like irrational and then you just can't do anything about it. It's that there are predictable errors that can be isolated and then reversed, and then you can win once you've isolated and reversed them, which I thought was just kind of brilliant. Okay, and I also wanted to say that when we were talking about how assets are priced, right, whether it's using the fundamentals, using the macro environment, using the emotional stuff, using technical stuff. So there's a chapter in my book called Why Did That Stock Price Move? Where I go over all of those, right? Including the behavioral stuff, including Kahneman and Tversky, including Thaler, including animal spirits, John Maynard Keynes, things like that. So if any of that is unfamiliar to you, I do this all the time. I just give away a free chapter of my book. So you can always email me, kjacks@moneyinyour20s.com, and I will send you that chapter called Why Did That Stock Price Move, that goes over all of these things. When is it fundamentals? What is fundamentals? That's the balance sheet, the earnings, the leadership team, things like that. Who's the CEO? Did the CEO just change? What's the macro? That's like the jobs data, the inflation data, the interest rates, what's the Fed doing, things like that. So if anybody wants that, just email me, kjacks@moneyinyour20s.com. And also that's the same email that you can use if you want to react to what we decided on for next year. Okay, so did that. Okay, we're pretty much at the end. I just want to go back and make sure there was nothing I missed. Okay, so we're really at the Q&A of if anybody has any questions, you can unmute, you can go into the chat. But just as sort of this last thing, please look at these suggested 10 webinars and react to them. What do you like? What do you not like? What should we definitely do? What could you stand to miss? We really want your input. And so Young is in the chat. She put her email in the chat.
I received the email already.
Oh, fantastic. Oh,
Looking
great.
forward to asset allocation. Would be interested in the session about evaluating the tax environment of different states for retirement. I'll forward the email to you. Or after I wait for 2 weeks, if I hear from everybody, I'll put in one email and let you know.
Oh, that's great. Well, we would, really seriously, people, we would love to hear from you. And in the chat, I'm going to read Young's email again. So she's Young Wong at Greenwich Library. So it's Y, and then Wong. Well, I know I'm mispronouncing this, but
YWANG at greenwichlibrary.org.
Perfect. Okay. And then I'll go to the slide that has mine at the end. There we go. Okay. And so I'm kjacks at moneyinyour20s.com. And please tell us what you think, participate. We'd love to hear it. And if anybody has any questions about tonight, about Richard Thaler, about Kahneman and Tversky, about Bob Schiller, about behavioral economics, about rigid economics before behavioral economics, unmute or put it in the chat. Otherwise, we are pretty close to time.
Okay, if no more questions, thank you, Kristen, and thank you everyone for coming. And this is end of this season. The next year will start in September. Please check the library's calendar of events and register 3 weeks in advance. Thank you.
Oh, wait, one thing in the chat. Oh, thank you so much. Thanks, everybody. Have a great night.
Thank you. Good night.
Good night.